So I'll walk you through the structure of how these transactions actually work. I'm going to start with a relatively uncommon transaction, what I'll call just a simple seller finance transaction, and then I'll build upon that to show you a more typical leverage transaction using outside bank financing, which is most of what we see. So in a simple seller finance transaction, we have three parties. You have the company, who then forms an ESOP, sponsors an ESOP, and then you have the selling shareholder. In this case, the shareholder and the ESOP simply exchange stock for a note. ESOP gives a note payable to the shareholder, and the ESOP receives the stock from the selling shareholder. Very, very simple. And then every year, the company makes tax-deductible contributions to the plan, which the plan then uses to pay the note to the shareholder. So that is how you accomplish the pre-tax nature of the transaction, because both principal and interest on the transaction debt are being run through the ESOP trust as a completely deductible retirement plan contribution. Okay? Now, what is more typically seen, because the seller seeks some liquidity at closing, okay, and doesn't want to retain all of the risk of that transaction, is we'll go to the bank. And we'll say, dear bank, this company's worth $40 million, just following our example. Here's the financials. What are you willing to lend to this company in order to affect this transaction? And in this case, just to give a very conservative example, I said, okay, the bank is willing to lend $10 million to this company, 25% of its fair market value. Okay, but could you also please give us an additional $30 million bridge loan, I'll call it, or a one-day loan is also what it's known as. This is purely an accommodation to accomplish the structure. So the bank says, sure, as long as that money never leaves my bank, I'll give you a one-day loan for $30 million. By the way, in the example of the Hawaii company that's closing this month, it was a $20 million senior term loan against a $40 million valuation. So 50% of the value was financed, non-recourse. So next step, the company takes this $40 million that it just received from the bank and loans it to the ESOP trust. And the loan is an important word because the trust gives back a note to the company in exchange for that $40 million. That wasn't a contribution, it was a loan. And that creates what we call in the industry the inside loan. Next, the ESOP uses that $40 million to purchase all of the outstanding stock from the existing shareholder. So at that moment, shareholder no longer owns any of the stock, he now has $40 million of cash. But the bank was not willing to lend $40 million. The bank, in this case, was willing to lend 10. So the seller then lends $30 million back to the company and takes back a note. We call that the seller note. And then the company uses that loan proceeds to repay the one day or the bridge loan to the bank. So once all the dust settles at this point, the sole shareholder is the ESOP trust. The ESOP owes the company $40 million. In step 2, that inside loan got created. The shareholder got $10 million cash at close and took back a $30 million note from the company. The company owes the bank $10 million and owes the selling shareholder $30 million. That seller note is going to be subordinated to the term debt. So the bank will get repaid first. And then once the bank is repaid, then the seller note either is amortized or is refinanced with additional bank borrowings. So that is admittedly a lot more complicated than the seller finance transaction, but this is 90% of what we see today. And why do we see this? Because it gives the most cash at close possible to the selling shareholder and gets us to that 100% ESOP ownership right away so that the company can become tax exempt post-transaction. That's a big, big selling point, and it also helps secure more financing from the bank. When the bank understands that the company is going to be tax exempt post-transaction and the cash flow is going to be much better as a result, significantly enhanced, the bank is willing to lend more and to forego the personal guarantee. So what, again, just to reiterate, what does this mean to the seller? So the seller is going to take, of that $10 million cash at closing, they need to take 10% of the transaction value, which is $40 million times 10% is $4 million. And they're going to use that, in the most typical case, to purchase leveraged qualified replacement property. Part of this 1042 election, where they don't pay capital gains at closing, requires them to reinvest 100% of their sales proceeds in qualifying replacement property. Little tough to buy $40 million of qualified replacement property when you only got $10 million at closing, right? So there are market participants here, UBS, Morgan Stanley, Merrill Lynch, Deutsche Bank, that will lend qualified replacement property at 90% loan to value. Okay, so you would need, in this case, $4 million. You would send it to one of these institutional lenders. They would acquire $40 million worth of replacement property, and that's your deferral. And you've locked in your deferral at that point. These securities, we can talk more about it later, but they're very, very specialized to the ESOP industry. They're designed so that you will not outlive them. Some of them are 50-year term, some of them 40, 50-year term, non-callable bonds. And great collateral. They're AA plus rated issuers. So that's why they're willing to lend 90% against the value of these bonds. So the other $6 million of the 10 that the seller got at closing, is free to do whatever he wants with it. Right? He can use it to pay down debt, use it to buy a second home, he can invest for his retirement. And then, as the $30 million seller note is either refinanced or amortized, then the seller can do, again, anything they wish with that portion of the proceeds. It can be invested, can be gifted, can be whatever you want. And then, again, the point here is that in blue, this seller note, because it is subordinated to the bank debt, it's junior and subordinated unsecured, carries a higher internal rate of return than what the bank's getting. So where the bank might be getting 3 3/4, 4 1/4, somewhere in that range typically, the seller note, it has a higher return. And often we see anywhere in the range of 11 to 15% total return on the seller notes. Now, because the seller does not want to strangle the company with interest payments, while it's also deleveraging with the senior debt, usually the cash coupon on the seller notes is small. It's 4 or 5%. The rest of the return comes in the form of detachable stock purchase warrants. So think of similar to stock options. They're issued in connection with the financing to enhance the return of the note. And when all the debt is retired, then the seller will put those warrants back to the company and get a second payout at that point. And then the seller note is either amortized or refinanced after the term debt is gone. The stock that the ESOP purchased, that big bucket of stock, is going to be allocated over a very long period of time, if desired. We typically see between 20 and 35 years. The idea there is that you want to create a long-term, sustainable retirement plan that's going to benefit not only the current employees, but also future employees, and is going to provide stock in the company where they work to be allocated over decades. Okay? And then ultimately, we want to make that at selection and become tax exempt.